All right, everybody. Happy Thursday. Happy Thursday. Welcome to I'm not sure where we are. I think we're week 8 now of our contract to closing table mastery for Florida Realtor series. We're on week 8, and this has been a pretty much a joy and a pleasure. I think we're on week 8. We'll know shortly, because we have our roadmap in front of us. Um, while everyone's coming in the room, I do see a couple new names, but mostly familiar faces. Some names and some faces I haven't seen in a long time. So good to see you, even if it's virtually. But for those who I have not had an opportunity to meet before, my name is Ray Cole Jackson. I'm a South Florida finance and real estate attorney. A little bit about me personally and why I do what I do and why I have a little bit of experience in this and kind of can a bit of credentials or credibility in leading this conversation. Um, Originally from South Florida, went to the University of Florida, so I always say go Gators. I say this every week because I know there's always some Seminoles in the room or someone that likes Seminoles, so I always say go Gators. Went on to California where I attended the Santa Clara University School of Law, where I was the founder of the Real Estate Law Society. Have always had interest in real estate. Came back home to Miami, got my LLM in real property development from University of Miami School of Law. So go Cane secondarily. I know Jess is in the room. I'm also a licensed, she said that you. I am also a licensed Florida realtor and loan officer in Florida. Actually, if those of you that follow me on social media in Georgia now as well, hey, we did Georgia over the weekend. We did Georgia real estate and mortgage, but we primarily do business in Florida. So there's that. But I might need to update that. Georgia and Florida. True Southern
Come
girl,
on
right?
now.
Come on. All right. So, with that being said, thank you. Thank you. And trust me, it was uh, just that wasn't a walk in the park, but we got it done. Just time, right? Just a little bit of time and focus. With that being said, with our training this week, or this quarter, focused on title. Our trainings are powered by title experts, our title insurance and settlement services firm. We close all of Florida. We work with many of you already joyfully. One thing I always say that this is a quid pro quo, these trainings that we have, because you will find, if you have not already, you will find that you're informed, or clients that are educated about real estate, they're your easiest clients to work with all day long. And so the same goes for you guys. Those of you that know the business, those of you that are experienced and that have taken the time to learn the business are a joy to work with. So those of you that are still learning, we'll work with you too. But we definitely want to always get our realtors up to speed so that there's a pleasant closing experience all the way around. All right. So we are on week 8. For those of you that are just joining us, this is kind of where we've been over the prior 7 weeks. Today we are reviewing the ALTA and the closing disclosure. What you need to know as a realtor about those two different settlement statements. Grab the handout, as we always do, labhandout.com. This week's handout is pretty meaty. Got a lot of stuff in there this week. We have, of course, the content for today. And I actually added in from last week, I added back in some descriptions because last week we talked about the different contract closing costs that are listed in paragraph 9. So I added in this week a Word document that describes those closing costs in a little bit of a narrative format, right? So we have that in there. And then you also have some sample settlement statements. You have two CDs, you have a full CD, a seller CD, and then you have an Alta. All right. So this week's handout is a little meaty, right? Something to work with. So, with that being said, today's discussion, close the disclosure versus Alta settlement statement, the Florida Realtors playbook for a seamless closing. Now, the first thing we want to do, we want to lay the groundwork. The first thing, RIP HUD 1. If we're going to learn, if we're going to be professionals, we should know that a HUD is that's old language. We don't say HUD anymore. That's old news. Labhandout.com. Type that in the chat for me, please, Rihanna. Labhandout.com. We don't call it a HUD 1 anymore. That's an old form of the settlement statement. If you say it, then folks will know what you're talking about, but they also might think that you are like rusty dusty because exactly that was back in the days. That was back in the days. We don't. That's like you using a like you have a house phone, right? Who has house phones? I mean, they're great, but kind of obsolete at this point. So we no longer call them a HUD 1. We have either the closing disclosure, which is also known as a CD, or not a compact disc, but a CD, and the ALTA Settlement Statement. So when someone says HUD today, they're referring to the settlement statement. But again, you guys, unless you know it's a little slip, you won't say a HUD anymore because that's just not accurate information. All right, that's not an appropriate description. Again, remember we have the CD and then we have the ALTA. So let's get into the difference between these two settlement statements. If you've never known why we have two different settlement statements, the CD, that is a federally regulated closing statement. And the information, not only the information on the settlement statement, but also the manner in which the information is what we say disclosed or stated on the CD is mandated by federal law. There are federal laws around what needs to be on the CD and how it should be disclosed. That's why it's called a closing disclosure. The figures that are on that statement, the government calls that disclosing. Calls that disclosing. All right. Um, he said he has a house phone. Oh boy. Um, and so the loan terms, the interest rate payments, closing costs, all of those items, they are federally regulated. And you guys have probably heard the term before, tolerance. Tolerance means that the amount by which they can change from the initial CD that goes out to the buyer. There are buckets. If you've ever heard this, they also call it buckets, the different sections of the closing disclosure. And we're going to discuss that just shortly. So that's federally regulated, federally regulated, federally regulated. And if there's any issues with that CD, the lender is on the hook, right? So they can be audited. And the lender will say, well, your tolerance is over. You have an amount for your points changed significantly. Your APR changed significantly, and you did not do what was necessary. You didn't redisclose, right? So when you're hearing this language from your loan officers and your lenders about tolerance and redisclosing, it's because there's a federal law around. There are federal laws around how that CD has to be handled by the lender. Okay. Alternatively, is the ALTA, the settlement statement. That's the one we love. That's like the nice little trusty dusty ALTA. And that one is not federally regulated at all. That is a form template that has been created by the American Land and Title Association. So the ALTA, that's why it's called an ALTA. That's an acronym for American Land and Title Association. And so that is the one that is most commonly utilized by that's the one that's utilized by most everyone, right? When you get that's sent out at closing. That's what you're seeing as you're working up to closing. You asking for a draft ALTA or a draft settlement statement, right? No one in this room will ever say a draft HUD, right? That's archaic, right? So the CD, you know that there's different sections in that CD. Again, you guys have the handout. Drop the link again in the chat, Rihanna, because we have folks that are coming in. Labhandout.com. On the CD, you'll see that there's different sections. Those different sections have different tolerance levels that cannot change, right? They cannot change. And if they do change, then you start the clock over for that lender and that buyer, for the buyer to have an opportunity to review it and decide whether or not they're okay with it, right? So you have the loan terms and the interest rates, you have their closing cost, you have their escrow and their prepaid items there on the CD, and then at the bottom, the very bottom of the first page, you see their cash to close. Now, just in case someone is like swirling around in their head, going back to cash to close on the purchase and sale contract. On the purchase and sale contract, you don't have to have that number exact for you to draft an offer. It's an estimate. And you don't have to know, you're not going to know all these different figures when you are preparing an offer. The only thing you know is purchase price, the offered purchase price, the earnest money deposit, their loan amount, and then their cash or close is just the balance of that. You don't have to worry about, oh, well, wait a minute, what's the interest rate and what's the the escrows and the impounds and the prepayments. You don't have to know all of that, right? All of that will come. All of that will come as the lender works through the loan and then they issue a closing disclosure. All right. So the CD, what I would say to you, obviously is very technical. Versus the ALTA, everyone loves the ALTA because it's a ledger. You see debits and credits, right? What we're charging, what we're charging the buyer or seller. You have the seller side and the buyer side, and you literally just volley back and forth down the line, right? So, what are some credits we see to the seller? The purchase price. You're crediting them the earnest money deposit, of course, and then the loan proceeds are going to be credited to the buyer, right? Like this is the amount that they brought in. They brought in the earnest money deposit. They brought in loan proceeds. Charges, things that you see as debits are payoffs that's charged to the seller, commissions charged to the seller or the buyer, depending upon how you structured the transaction. Prorations can go either way, right? We know that prorations is where you take a set amount and you determine how much of that set amount needs to be charged to the buyer or seller and how much of it should be credited to the buyer or seller. That's a proration. Proration. I'm going to say that again. If you hear the term proration, the only thing you need to understand is a proration is you are taking a one set figure and you're determining based upon the number of days that are covered by that figure, how many of those days should be charged to one party, credited to the other. So let's say, for example, we have a $30 monthly HOA fee. It's a 30-day month, closing on the 15th. Generally, the day of closing is charged to the buyer. If the $30 has already been paid at the beginning of the month, $14 are going to be the seller, of course, will be responsible for those $14. They will get a credit for the other 16 days. The buyer is going to be charged for the other 16 days. We're closing on the 15th. Buyer is going to be charged for the 15th through the 30th. The seller is going to be credited for the 15th through the 30th. That's a proration. And those numbers just get larger and larger and larger depending upon whatever number you're looking at. Taxes is another proration. We have a slide on that just shortly, right? Title and recording are charges as well. So let's look at it as a comparison so that you know the difference. A closing disclosure is focused on the loan. It is focused on the loan. And so all the items, the focus you're going to see on that CD, again, prepayment penalties, you're going to see what their estimated monthly payment is going to be. You're going to see there's their APR. If you go further into the document, all the terms concerning the loan itself are on the closing disclosure. You don't see that on the ALTA. We don't tell them what their APR is going to be because that's not the ALTA is just about the transaction, the raw numbers, money in, money out, who's being charged for, who's being credited. The closing disclosure. You guys should know that when you guys hear the term matching and balancing, what we're doing there is the lender is sending their figures. 90% of the figures that are on the closing disclosure or settlement statement, they come from the lender. They come from the lender. So the buyers should know that because when they see numbers change, oftentimes they reach out to the title agent, particularly at close once we were getting closer to closing, and they're like, "Well, what is this figure?" It came from the lender. You guys should know that too. It came from the lender. So when we match and balance, we are saying when we put your numbers into our system, we match and then we balance as to the amount that we expect you to send in your loan proceeds, as well as what we expect the buyer to send in as their cash to close. That's what matching and balancing is. Lenders sending their figures, we're sending them our figures, the title costs, them saying, yes, we match and balance, we saying, yes, we match and balance with you. When we ultimately close, the closing disclosure that is used, the actual document, it comes from the lender. It has a serial number on the bottom of it and everything. That is the lender's document. Because again, if there's any issues with that closing disclosure, government's gonna come to them, not to the title agent, right? So that's something that you guys should know. Um, Back in the day when we first started using closing disclosure, I think in about in 2015, there was some confusion around um sharing the closing disclosure, and it really, I mean, it's not top secret, but it is more detailed loan information than an ALTA. So there was some conversation about sharing the borrower's full CD. It's not even asked for anymore. Like when you guys close, along with your confirmation of disbursement, what are you getting? You're getting an ALTA. And you really shouldn't be asking for anything other than that, right? And I'm gonna tell you the other reason why you should prefer an ALTA over a CD. You should prefer an ALTA over a CD because the closing disclosure is very buyer focused. The lender is not going to update. Remember, this is the lender's document. When they match and balance, they're matching and balancing all on the buyer side. They're not looking at anything on the seller side. So you very well likely, if you are focusing on just the CD, you would have an incomplete CD as it relates to the seller's cost, because that's not an issue for them. They don't care. They're being regulated on the buyer's cost. All right. So again, you guys don't ask for CDs anymore anyway. You shouldn't be asking for it. You should always be getting an ALTA. But with that being said, that's why you don't want a CD, because it's for the most part incomplete. Okay. Now we do you do you if you're ever somehow a party to the funding approval process with a seller, and you hear the lender say we need the seller signed CD, well, that's our CD. And so that CD with will be complete with seller's figures because we've entered seller's figures accurately. So it's not that the lenders are only focused on the buyer CD. They do request a seller CD as well, but they don't prepare the seller CD that's signed. The closing agent prepares the seller CD that's signed. The lender prepares the buyer CD that's signed because again, that is their document. They're audited on it, and it is a serial number at the bottom of it. Okay? All right. So why might the numbers look different? If by chance you have you get access to the final CD, which sometimes you do because you may be on the email that goes out to the buyer that says, hey, here's your final CD with your cash to close. And so you look at the final CD and you look at the final ALTA and you're like, the numbers are the same at the bottom, but when we get up in here in the title insurance and a couple of these other costs, they don't match line for line. The reason why is what I told you earlier. The closing disclosure has a federally regulated way that particular costs must be disclosed or entered on the CD versus the ALTA. The most important, um, the most important difference is title insurance. On a finance transaction, the closing disclosure. So first of all, you should know that the closing disclosure is utilized if it's a finance transaction, obviously. But make sure that we don't just assume that. You're going to use a CD on a finance transaction under A TRID loan, truth in lending, right? Someone said, what is truth in lending? TILA integrated disclosure. That's what TRID stands for. TILA, truth in lending, RESPA, Real Estate Settlement Procedures Act. Y'all working on my memory. Integrated, meaning they've merged the two into one disclosure. How about that? Jessica's laughing. TRID. TRID stands for TILA, which stands for Truth in Lending Act. R stands for RESPA, Real Estate Settlement Procedures Act. I, Integrated Disclosure. Ta-da. All right. So, as I was saying, the main figure that's going to look different on the CD versus the ALTA. Sonia, why are you laughing? You're testing my gangster today. See, you got to keep at notice stuff. The main thing that's going to look different on the CD versus the ALTA is title insurance. Here's why. I don't know why they do this, but they do. Title insurance, remember, we talked about last week, there's an owner's policy, there's a lender's policy. And then there's just, let's say, for example, it's $1,000 total for both policies. The CD, federal regulation requires, for whatever reason, that $1,000, even though let's say the actual cost of the owner's policy is $750, the actual cost of the lender's policy is $250. For whatever reason, the federal regulation is that $1,000 bucket first be allocated to the lender's policy, and it's going to show the lender's policy being, $850 or something. And then the lender's policy, and then there being a credit to the buyer by the seller at the bottom. I don't know why they do it. It is completely confusing. Nobody ever understands it. It's so confusing to the extent that at closing, the buyers have to sign. Florida has a form that has the buyer sign and say, I know this is what your title insurance costs are going to look like on the CD. This is what they're going to look like on the ALTA. This is what the actual cost is. We have an actual separate form for that. So again, for your purposes, if you get these two documents and you're comparing them side by side, you get to the title insurance policies and the numbers don't match, don't freak out and say somebody's messing up something here. It's because they must be disclosed a particular way on the CD, different than how they are on the ALTA settlement statement. Now, with that being said, outside of that figure, because every other figure should be the same, if you do go line by line, again, you don't really have a need to, but should you be testing your knowledge on an upcoming closing and you see a difference, don't just assume that it's a formatting difference. You want to ask, like, is it? Because it's possible. Maybe the document wasn't refreshed. I don't know. Again, now that you guys have been educated on this, now you're going to see things and you may have questions. It's okay to ask the question. Okay? But again, for the purposes of the discussion on this particular point, if all other figures are the same, the only difference you're seeing is with the title insurance. That's why. Title insurance is disclosed differently on the CD than it is on the ALTA. All right? Because again, remember, the CD is about disclosure, how things must be presented to the buyer versus money in, money out register of the ALTA. All right, with that being said, you guys have heard, I'm sure, about the 3-day disclosure period. Here we go. The law requires that buyers have 3 business days to review the CD before closing, and it cannot be rushed. They cannot waive this. It is a mandatory, some call it a cooling off period, but it's a disclosure period. There was a time when a buyer would get a CD at the closing table and say, "What in the world? How did this happen? When did my APR go to this, or when did my prepaid increase to this, or my cash to close is now 20 grand instead of 13?" There was a time. Um, Now, with that being said, there we do still have today when the buyer gets their CD at the 3-day disclosure period, there's still some conversations being had. But again, it's not the day of closing, right? Because there is now this 3-day mandatory disclosure period for the CD. So with that being said, here's what you need to know. Late changes can create delays. Don't think you can get to a walkthrough and just throw a big credit in there for maybe a repair or something. You could throw off ratios, and that could not be the case. Don't think that you can just agree to an additional seller concession and you still close tomorrow. What if you have, an FHA loan, buyer only put down 3.5%, and the seller is trying to give, you know, an additional 5%? Well, no, your numbers are off. You can't do that. So any credits, any changes, you need to provide those to the lender as soon as possible. And again, remember, this is a great opportunity to have this conversation. Don't think giving it to title is sufficient. You need to give it to the lender. Because remember what I told you guys, the lenders are responsible for that CD complying with federal regulation. If you give it to us, we're going to drop it in, money out. All right, we still balance. And there have been situations where lenders have found out at the 11th hour about a credit because that addendum was not provided to the lender. You want to provide every monetary addendum, every monetary change to both the lender and the closing agent immediately. Right? So, what are some changes that can impact that 3-day disclosure? Minor changes won't impact it. Again, APR changes, loan product changes, buyers going from FHA to conventional, from conventional to FHA, addition of a prepayment penalty, for example. These are some pretty big changes. These don't commonly happen, but you need to know. Stranger things have happened, right? You could be in business for 20 years and all of a sudden you get the one where, there's an addition of a prepayment penalty at the 11th hour. So you should know that. Now, with that being said, we can't talk about CDs without going back to the purchase and sale contract. How many of you remember paragraph 5A, the built-in extension for the disclosure, the 3-day disclosure period? There's a built-in extension of the closing date if the lender does not meet their 3-day disclosure requirement. It's built in. When you sign the contract, you've already agreed to it. The buyer and the seller have already agreed to this. That if I do not meet my 3-day disclosure, if the lender cannot meet their 3-day disclosure period before closing, then we have to extend the closing date for a period of time not to exceed 7 days. Now, here's what's important here. You guys must know this because I've been a witness to conversations with lenders who misinterpret paragraph 5A of your as-is contract. Here's the misinterpretation. Paragraph 5A, first of all, requires that, number one, 8B must have been checked when you went under contract, meaning you must have said that this was a finance transaction when you went under contract. You guys know that a buyer can make a cash offer, and then they can later on change to finance, but you do not get to now clothe yourself in the protections of a finance transaction, particularly 5A, because you've changed the terms. You can go get financing, but again, you cannot clothe yourself in the protections of a finance transaction because you were not a finance transaction when the offer was accepted. Are we clear on that? So it must be a finance transaction from the time you went under contract. The second requirement to utilize 5A, loan approval must be obtained. Okay, see, Sonia says she's had it happen. Loan approval must have been obtained, meaning this loan has to be approved. This was a change in our contract a while back because lenders were using 5A as an opportunity to keep underwriting the loan. No, sir. No, sir. No, ma'am. That's not what this is for. Loan approval has to have been obtained, And underwriting is complete. You're not looking for one more bank statement. You're not looking for uh, the last page of the last tax return. No. Underwriting is complete. We have loan approval. The only thing we're waiting for is to give this buyer their 3-day disclosure period. Y'all got to have this tight. You got to have this tight. So let's add a little bit more texture to this. So, what does this look like? You know your loan approval deadline. Depending upon how you drafted your contract, you're generally about 7, 10 days out from your actual closing date. What this should tell you as a realtor is number one, honor your loan approval deadline. Not for the purpose of you just must be ready, but because you know that once you pass the loan approval deadline, now you're in escrow deposit not being returned territory unless the seller agrees to it. So what you want is to make sure as you get to that loan approval deadline, you are in constant communication with that lender to say, hey, are we good? You don't want anything to come up as a condition past your loan approval deadline other than something very basic, which is verification of employment, last minute, re-verification of employment, last minute credit pull. You should not be still clearing major conditions 3 days prior to closing. All right. All right. So this goes both ways. It goes for a buyer's agent to know that don't try to use this if you're not ready, as well as a seller's agent. Don't let a lender use this against you if you know that they don't have loan approval. All right. So, with this being said, you don't want to casually tell a client, oh, we'll just automatically get 7 more days because the lender's not ready. No, you won't. Mm-mm. Because it's only up to 7 days as necessary. And that 7 days includes like weekends, right? Like if you need to get, because you need the 3 business days. So you're not going to get seven business days to close. No, you get as many more business days as needed to meet that 3-day disclosure period. All right. All right. So a couple things to know about reviewing the settlement statement. Number one, the basics. Here, you should definitely know how to confirm the purchase price. You should know where to verify the earnest money deposit. Again, you guys have this in the handout. The easier form to review is the ALTA Settlement Statement that's in your handout. Purchase price line one, earnest money deposit, any seller concessions you're going to see on there. I think on the handout I gave you a seller concession on there as an example. Any HOA charges, those are easy. Home warranty, you'll see that if you made a mistake and did not check it. I've had that happen before where the seller accepted an offer that had a home warranty in it because the the listing agent clearly just blew by that section. Didn't even realize that there was an amount in there. Oh, found out about it on the settlement statement. Here we are, right? So that means make sure you review your offers in their entirety. Now, the money, of course, the commission. This is what you guys have to be clear on, especially now with the difference in the commission structure. You want to make sure that you see commission on the side that should be charged for it. Many of you, you're just used to seeing the commissions all on the seller side. If that's how your transaction is structured, fine, all on the seller side. But if you know that your seller has not agreed to compensation and you see two commission debits on the seller side, you need to say something. It likely is just a mistake on the closing agent's part because they're just automatically conditioned to putting commissions on the seller side. Well, you need to be able to identify that and say, hey, that's a buyer's charge. That needs to be on the buyer's side, right? If there's a referral fee that needs to be added and any of your transaction fees, you don't want to assume the commission is just correct. And then we have the adjustments. You should know how to find your seller credits. You should know how to find these credits on the settlement statement. Again, it'll specifically say seller credit. It'll be a debit to the seller, credit to the buyer. This is why we like the ALTA. Debit, credit. debit, credit, right? Rent prorations. Don't miss this. If you know the property is being sold, if it's an investment property, is being sold with a tenant in there, you want to see a credit for security deposits, if any have been collected, and then you want to see credits, prorations for rental payments that have been made that month if they've already been collected. Generally, if you close anytime after about the 5th of the month, you should see a credit for a debit and a credit for some rent that's been paid that month. And then our tax prorations. We're going to go over tax prorations just in a moment on its own slide because that's its own animal, right? So, myth versus reality regarding some of these figures on the settlement statement. The title company is responsible for catching everything. That's not true. It's just not. First of all, the closing agent is human and mistakes can be made. Um, Second of all, the closing agent only knows what they are told, particularly as it relates to commission. I want to hit commission again because that's most times commissions, seller credits, anything that's on a document, the HOA estoppel, that's black and white. Lien search, that's black and white. But when it comes to commissions, you guys already know you don't need to send your commission agreements. That is just completely too much information. Keep that. There's nothing, don't need that, right? The intake form that says how much you're being paid, what needs to be completed. I would even, if I was the listing agent, because we have our form set up this way, I would make sure that I even notify, especially if the commission is being paid by the seller, I will make sure that the closing agent is made aware of the compensation that's being paid to the buyer's agent by my seller. I would not just wait for the buyer's agent to inform the closing agent 2% to me paid by the seller. I wouldn't. I would make sure I would be proactive about that, right? Now, with that being said, before you close, guys, check the settlement statement to ensure that your commission is correct and the appropriate party is paying it. Don't think that you're going to go back to the closing agent and say, "Oh, you got my commission wrong. You need to pay me." Mm-mm. You should have reviewed it. You got to review it. Now, how often does this happen? Doesn't happen very often, but where it does happen, especially you need to be on alert if you are being paid by the buyer. If the transaction has, and I, because I've seen this one where the buyer's agent missed it. They never even sent in anything that said that the buyer should have been paying something in addition to the seller. Um, and I'll let you guys know in full disclosure, it was, ooh, you know, I work a full-time job and we're doing real estate. That's not an excuse, but that can show you how your attention can be, what do you call it, split. And so the agent's like, oh my God, I completely missed it because I'm working and I'm doing a transaction and I just did not review it. I didn't send the form in. Okay. So don't mess up your credits. Don't mess up your commission. Again, don't assume that it's correct. Don't assume that the credits are going to be that the credits are there. Folks are human. Review it. Make sure it's there. Coming about the bin, property taxes. Again, you don't need to know this exactly as far as calculation, but you should be aware of this. And this is a good opportunity for you to visually see when we say that property taxes are paid in arrears. This was on your real estate exam, we know. So what does this look like visually? Ad valorem taxes, value taxes, the biggest tax that's paid at closing is paid in arrears. That means they are paid at the end of the year after they've been accrued. They're paid at the end of the year after they accrue. So, what generally happens is the seller owes the buyer a credit for the portion of the year that they lived in the property before the final tax bill was issued. So, this period here, the seller lived in the property from January 1st to, let's call this December, November, let's call this August. Call this August, right? So the seller is responsible from January 1st to August 8th. No, August 7th. We're closing on August 8th. Because remember, generally the buyer is responsible for the day of closing. So on the settlement statement, you're going to see a credit for this amount of taxes. Remember, I told you guys what a proration was. Let's say the taxes for this year, for the annual ad valorem taxes on this property is $365. We close on day 300. The seller's responsible for days 1 through 299. So that's $299. The seller is going to credit the buyer so that when the buyer's responsible for paying those taxes at the end of the year, the buyer's not paying for the time that the seller owned the property. That's what tax proration is. And then, of course, the buyer's responsible for day 300 all the way to day 365. All right. You're not going to see a charge to the buyer because generally, until we get into November, when taxes are being paid, you're not going to see the taxes. The taxes are not going to be actually collected at closing unless there's a pass-through tax bill, which that's a full figure that's on the settlement statement. Pass-through taxes, which is a possibility, they are paid at closing. All taxes are paid at closing. You are not going to close with unpaid taxes. Can you close? Potentially, but if you do, like we talked about weeks before, that's going to be an exception to the policy, and everybody's going to be made aware that you close with unpaid taxes because the state can foreclose on their unpaid taxes, right? So with that being said, again, unpaid taxes, this is our day of closing. Seller's going to credit the buyer for this period. Buyer's going to be responsible. The buyer's going to pay for this portion. But on December 31st, because the buyer now owns the property, they're responsible for all of this. So that's why the seller has to pay them. Now, we know that non-ad valorem taxes, which is taxes that the property is assessed for resources to the property, those are paid in advance. So that's the complete opposite. You would flip this. The buyer is going to pay for, if this were ad valorem, the seller has already paid up to into next year. So the buyer is going to be crediting the seller for non-ad valorem taxes. Seller has paid for a period of time that they're not even in the property anymore. Buyer is crediting the seller for non-ad valorem taxes. They are debiting the seller for ad valorem taxes. So those are two different taxes in the state of Florida. Now, what are some other prorations we talked about at HOA dues? We could use this same visual. HOA dues, if this represents a full month of HOA fees, seller has owned the property for this amount of days. We're closing on this day, but the seller has already paid. Buyer is going to be crediting the seller for this number of days of HOA fees that have already been paid. All right. Let's say this was a rent payment for an investment property. Seller has collected already rent at the beginning of the month for this entire month. We're closing on this day. Buyer is entitled to a credit for this amount of days of ownership of the property. All right. The security deposit should be the full amount. That is not a proration. That is the full amount of any security deposit that has been collected by the seller. I'm going to say that again because that's important. The full amount of the security deposit should be credited to the buyer. Why? Because when the tenant moves out, the full amount of their security deposit, less any cost deductions, appropriate deductions, needs to be returned to the tenant. There's no proration on that. The full amount of the security deposit, you should see it on the settlement statement. All right. All right. Now, closing costs, my cash to close. What should happen? We get to closing and the buyer's like, wait a minute. This is not the number that I expected. This happens very often, more often than we would like. And sometimes the number is not astronomical. Sometimes it's a misunderstanding, right? And oftentimes it is because remember, and this will help you too, because some of you guys see the number jump and you're like, what in the world happened here? Remember the you're getting an ALTA from the time you go into contract, from the time the file comes in for closing, right up until matching and balancing. There's not a lot of lender figures in there. And remember, I told you that 90% of the costs are lender figures. Those don't come until we're matching and balancing. So you're continuing to get a draft ALTA that's missing 90% of the figures. So the buyers keep watching that cash to close, and they're like, oh, okay, I can do that. Like, I got that in my piggy bank. And then you match and balance, and they're like, wait a minute. This number is way different than I saw coming through every week leading up to now. For your understanding, this is why. But here's what you should do in that regard. Number one, don't freak out, of course. Don't like, oh my God, this is crazy. You stay calm. Of course, you're going to look at the ALTA and see, you know, because you understand now that you're missing 90% of your figures until you get to matching and balancing. You'll explain that to your buyer. Um, you can take a look yourself, but more importantly, direct the buyer to the lender. That's it. Direct the buyer to the lender when they have questions about the cash to close. Your response is that's specifically because 90% of the figures don't come until we're preparing for closing. But that does not mean that you cannot ask the lender for an explanation. So let's get you on the phone with the lender. All right. Do not promise that the numbers are a mistake or that they'll change. Don't say, "Oh, we'll extend closing to get this corrected," because you can't promise that. And definitely don't give any legal or lending advice. Right? You guys have been introduced to a lot of information concerning how a lender's CD is prepared, what goes into it, but that does not make you a loan officer today. So don't go down that rabbit hole. Just direct them back to the lender to review that. All right. So let's knock out some myths. The ALTA replaces the CD. No, it doesn't. No, the ALTA does not replace the CD. They serve two different functions, and the lender will not close. They will not authorize us to fund without having a CD executed. The CD is so important that many of you probably, you might, if you have not already, you potentially are going to experience, hopefully you will experience because they are the best, closings where the buyer has a hybrid closing. A hybrid closing is when 75% of their closing package is signed electronically, and then they have what's called a wet sign package. That package is maybe 25 pages. It is the best thing ever. The CD is one of those documents that must be wet signed. It must be wet signed. Their CD, their mortgage, their note, and a couple other disclosures must be wet signed. And the ALTA never replaces a CD on a finance transaction. If you do a cash deal, you're going to see just an ALTA. You may even have a closing agent that's old school and they do a HUD one, but an ALTA it is, right? Remember the CD and the ALTA must match exactly. False, they don't. Remember I told you in certain sections, the figures are disclosed differently. The last title will catch my commission update. False, do not. They don't automatically know that you guys have made some changes, or maybe in a rush, they missed your email that said that it has changed, right? Again, for those of you who we've had an opportunity to work with before, and I bring this up all the time, you guys know that at the bottom of our emails, we require 2 business days from clear to close to closing, because there's a lot that must happen in between from the time the lender gives a clear to close. I just told you guys, we don't start matching and balancing going over the CD until there's a clear to close. So you have clear to close, you have updating title, you have scheduling parties to sign, you have setting up ledgers, you have setting up bank accounts. All these things must happen. You have having you guys review the ALTA and confirm that it's accurate, right? Imagine all of that trying to happen in a compressed 3 hours. Oh, that whole fictitious, oh, we got to clear to close. Can we close today? Absolutely not. There's too much that has to happen. And that's when mistakes happen. Okay? So, um, feel free to borrow that standard that you are relying on your lender to get you a clear to close at least 2 business days before your scheduled closing date to give everybody an opportunity to dot their I's and cross their T's. Because I assure you, when these things are missed, they're missed because the closing was rushed. Invariably. Invariably. Right? All right. So here's some of the things you should do. Has the buyer received and acknowledged the CD? You want to know that. That's the other thing, too. Now, of course, the lender should be on top of this, but can you guys believe that sometimes a closing can be pushed back because the CD was sent out, but the buyer did not acknowledge it? You know what acknowledge it means? They need to e-sign it. They'll get it in their email and they'll sign that they got it, and that starts the clock. And for whatever reason, sometimes the lender does not follow up, the loan officer does not follow up with the buyer to say, hey, check your email. We sent you the CD. We need you to acknowledge it so that we can meet our 3-day disclosure period. If you represent the buyer, it doesn't hurt for there to be another set of eyes on that. Okay. If you represent the seller, has the seller received the settlement statement? Oh yeah. Sellers get spicy too. What is this on my, why does it pay off this amount? I never agree. Well, how did you not agree to? It's been on here for like 2 weeks now, right? Or they start asking about some of the other fees on there. You want to make sure that the seller is watching that settlement statement as well. Are the credits correct? Is my commission correct? And then is this cash to close final? Because again, you just want to know if the cash to close is final, let's make sure that the buyer is getting themselves prepared to make that wire. So, being proactive. Early in the transaction, make sure you send in your commission. Make sure you send in any credits. Make sure during the transaction any changes are immediately sent to both title and the lender. And then in the final week, you want to make sure that you review the settlement statement to verify that all of these communications concerning figures have been addressed. Okay? Don't get to the day before, day of for sure. Day before, still time. But day of closing to say, wait a minute, where's my broker's processing fee? Excuse me? You had one job. Just kidding. So make sure that it's on there. All right? So your review checklist. So the ultimate takeaway, early communication wins. Early communication wins. You now know that the CD explains the loan, the ALTA explains the transaction. You want to make sure that you review transaction numbers early, commissions early, credits early. Stay in your lane. If there's an issue with that CD, direct the buyer to the lender. They when they come to closing to the closing team, I redirect them anyway. We're going to redirect them. But most buyers, I would say 50-50. We still get a few that are asking questions, but most have been redirected from the beginning to know that the lender is the one that is controlling the figures that they're seeing. All right. And then lastly, early communication. Just don't wait until the last minute for anything, guys. It's better to over communicate than under communicate and assume. The best realtors don't just wait for the closing documents to come in. They are proactively ensuring that the right info gets to the right people early enough to avoid surprises at the closing table. All right. Questions. Let's talk about it. Where are we? Woo! 4 minutes to spare. Questions. Clear as mud. We said a lot. We did a lot. We talked about a lot. Yes, Miss Lorraine.
What I wonder is, great afternoon, and thank you for an excellent class.
Not a
What
problem.
I'm wondering on our side, how
Mhm.
can we proactively find out, or if there isn't a way, if a seller says to us that they did a modification, how do we proactively prepare them to know that when they get the closing disclosure, the seller net sheet that we're providing to them may not
Mhm.
be exactly what their net payoff is going to be?
Asking for a payoff statement. It'll say
So
it
the
right.
modification would appear on, okay, well, if they
Yep.
ask for payoff, but not the last mortgage, but a payoff, okay.
Have them request. She said that's a good one. Have I would recommend as a general matter, once you go under, at the listing appointment is pretty early. They're probably not gonna want to provide you with that. But once you are listed, have them order a payoff statement and share it with you. It'll say it right on there. It'll tell you what your final amount is. So that's a
Okay.
very good question. Renee said the same thing. She says she does a lot of pre-foreclosures. Um, I will so for those of you that do the office hours, we talked about some pre-listing due diligence. And so we recommended that you, particularly on the listing side, working with sellers, that you have a relationship with an appraiser so that you can have some pretty strong due diligence on the valuation, that you look at public records so that you do a open permit code violation due diligence, that you obtain the payoff statement so that you have due diligence on the amount, any loan payoffs that they must have. And then we also talked about a 4 point, so you can do due diligence on the insurability of the property. Here's the deal. At this point, and I'm glad you raised that question, Lorraine, there's not much that should come up with that property that's a surprise to you once you go into contract. You can do so much. And then particularly, for example, if you are in the handout, you guys have the state of Florida map. If you're in a county where customarily the seller is going to select the closing agent, you should go ahead and send that file in for title to go ahead and order the title commitment. We have a couple agents that do that. I got a new listing. Can we order title, please? So I already know what I'm dealing with. There is no reason on the listing side for a lot of these surprises to happen. So a real relationship with an appraiser for valuation due diligence. Um, you can even do an inspection, pre-listing inspection. And someone asked a question about whether or not you now have to disclose everything that happened in the inspection report. Not necessarily. The seller's disclosure duty is for issues that cannot be identified by someone performing their own due diligence. So latent issues. So remember, I was used as an example. If the seller has a huge marble dining room table that's on top of a nice Persian rug, but it's like that because they know they have a hole in the floor. You know that, and you know there's no way for anyone to know that but for moving the table and the rug. So that's a latent defect. No inspector is going to move a table and a rug. So latent defects must be disclosed. But anything that you don't have, the seller doesn't have a responsibility to do a buyer's job. You got to do your own inspections, right? So you have that, and then you have your 4 point to ensure insurability, because insurance can become an issue with properties. Insurance could be too high, or issues, maybe with a roof or something along those lines. So I'm glad you asked that question. Any other questions? Any other questions? All right. Make sure that sometimes I know you guys are not getting someone's not getting a text message. Make sure that you are signed up to get your text messages reminders. And I think that's it. I think that did it for us today. Yeah. All right, guys. We did it. Oh, Candace, go ahead.
I too have a question. I know you're big on that GG form, and then in my brokerage, we use the confirmation of compensation to sellers or buyer's broker. And then there's another form. Do we need all three of those?
What's the confirmation? I don't know what your confirmation is. Explain it
Is
to me.
is it just confirms that the seller's willing to pay X amount, you
Is
know,
this a
for
brokerage form or is this one of
no,
the
I
Florida?
think it's I think it's a Florida Realtors, but it has my brokerage branding on it. But
So I'm gonna go through the forms and you tell me what I'm missing. So you have the the seller
be
compensation
right there.
agreement. You have the seller compensation agreement. So, and that is
Yep.
where you have the seller agreeing to compensate the buyer's agent.
Mm-hmm.
And then you have the writers. And the writer, one writer being um, closing cost credits. So that's where the buyer's going to use credits for their buyer's agent compensation. And then you have the contingency rider, where it's saying that the this offer is contingent upon the seller entering into an agreement
Yeah.
to compensate the buyer's
Right.
agent. So what's your question?
And then there's the compensation agreement, the seller or seller's broker to buyer's broker. Because
So
I have a transaction now and I was requested that in addition to the confirmation of compensation. So I was like,
so
do we have
remember
too much?
remember we used to have separate seller to compensate buyer's brokers to we had like what, four different forms that are
Yeah,
now
we did.
consolidated. So you only need the
Okay.
consolidated form and the rider if it's appropriate. And I
Okay.
recommend that you use the rider, yes. I always recommend, and I'm going to say this if you guys are not following what Candace is asking me, I always recommend that you use that rider, even when you have a compensation agreement executed, because if you the compensation agreement itself is separate from the contract. The only way that you make that compensation agreement part of the contract is to use that rider. Now, I'm not trying to scare you and make you, hair on fire. I've also explained to the group that even though you make the compensation a contingency of the contract, that doesn't necessarily always protect the buyer's agent, because what the contract is between the buyer and the seller. And if by chance, some type of way, the buyer and the seller agree, you know what, forget it. We don't want to have Candace's compensation tied up in our transaction. Let's agree to remove this contingency. You can't do anything about that. You can't do anything about that. So somebody just got scared because they're like, what in the world is she talking about? That's a whole nother conversation. But you guys you need to be aware that that is a thing, right? So I'm going to say it one more time, and then we probably have to have a whole nother training on this. We know that we have the seller's compensation agreement, and we know that we have the rider, and we have the contract. What I recommend always to realtors is that you use the rider, the compensation contingency rider, to link these three together, right? You link the contract to the compensation agreement, so that if by chance the seller goes rogue and says they're not paying, where you now my buyer doesn't have to close, because you've made this they've already said that them proceeding is contingent upon you executing this compensation agreement. But in the event that for some strange reason, they agree that that's no longer a contingency, or they're not requiring the seller to abide by that contingency, you would have to pursue that seller and even that buyer outside of the transaction. You can't stop the transaction from closing. All right. That's a whole nother training. And I got some language that does prevent it, but that's a whole nother training. All right,
Well,
guys.
thanks as always.
105. See y'all later. Bye. You're welcome, Jackie. Good to see you. See y'all later. Good to see you, Renee. Bye, Miss Moore.